Okay, thank you very much. Thank you. Welcome back. We have the next session at the Golub Center Conference here is on contingent assets and contingent liabilities, but it's two papers about quite different places that these show up in the government budget and sort of thinking differently about resolving those circumstances. And so what I'll do, well, I'm going to break the paper session. We had originally thought we'd have questions all at the end. I'm actually going to take a few questions after each of the two papers so that we can have a little more dialogue. So, because the papers cover quite different topics. The first paper we have by Doug Elmendorf here, who's formerly run two great organizations, both the Kennedy School and my favorite government agency, the Congressional Budget Office. And he's going to give us, is probably uniquely situated to give us good perspectives on policies to reduce federal budget deficits by increasing economic growth, which seems like the most rosy scenario for escaping from our fiscal woes. So, Doug, thank you very much.
Thank you, Jonathan. It's great to be here. Good morning, everybody. As Jonathan notes, this paper has a title that seems somewhat unusual for this conference, and I'm grateful to Debbie for encouraging us to present it. The paper is joint work with Glenn Hubbard from Columbia Business School and Zach Liscow, who's an economist at Yale Law School. But it actually was inspired by another economist, Heidi Williams, at Dartmouth College. Heidi and Glenn and I wrote a paper last fall for the Brookings Papers about how to incorporate effects on economic growth into budget estimates of the sort done by CBO. Heidi thought this was a natural follow-up project, but because she's doing work very much like this at the Congressional Budget Office, she had to drop off the paper, but she deserves as much credit as the rest of us. Let me see if I can make this happen. So we start the paper by talking about two challenges, two perhaps separate challenges, but actually we argue related challenges facing policymakers. The first is to put federal debt on a sustainable path, and you've seen pictures like this before. I've been looking at them and publishing them for years. Pictures don't seem to get any better. The other challenge facing policymakers is to foster robust economic growth. This is the piece we show here, the piece of economic growth that is productivity growth, total factor of productivity growth, which you can see has varied quite a bit over time. Over the last half dozen years has been sort of medium strong relative to the history. And so policymakers care about both putting the federal budget on a sustainable path and on fostering more economic growth. And our starting question then is, could policy changes address both challenges at once? And the natural nexus here is that faster economic growth reduces the fiscal imbalance. The bigger GDP is, the less burdensome any given amount of federal debt is. Moreover, faster growth reduces federal debt by increasing tax revenue. And faster economic growth has other benefits for the country as well. And if you look at some of the scenarios that CBO publishes, you can see that faster growth can matter a lot for the trajectory of federal debt. The dashed line in the middle here is CBO's latest long-term baseline projections. So this is assuming that current laws are not changed and looking out 30 years, which is as long as CBO feels comfortable going. If total factor productivity growth is a good deal faster than CBO expects, then the debt picture looks a good deal better. So the lower line here is one in which total factor productivity growth is not the 1 or 1.1% that CBO projects over the next 30 years, but is half a percentage point faster, so 1.6% per year. That's a pretty big difference in productivity, but it does make a big difference for debt. And then the, but then the question is, for policy changes, first, could policy changes increase growth enough to make a meaningful difference? I showed that growth has varied a lot over time, but mostly for reasons that are not a consequence of policy differences. But then also, if growth can make a big difference, can it do so at a low enough direct budgetary cost? Right? Faster growth increases revenue and reduces deficits, but if you're spurring the faster growth through cuts in taxes or increases in spending that have direct budgetary cost, then you may be making the budget situation worse, even if growth is better. So the key implication here is that magnitudes matter a lot. If you think about regulatory policies, and I'll talk about that in a moment in more detail, those changes tend to have very little direct budgetary cost. So if they can spur growth, that's probably good for the federal budget, but it still matters how much. Is this a small advantage or a big advantage? Another way magnitudes matter, of course, is if you do a tax cut or a spending increase, that has a direct budgetary cost. So the effect on the budget outlook depends on the magnitude of the growth impact relative to that direct cost. Moreover, the direct cost depends partly on the method of financing. If you look at a study CBO did in 2021, analyzing the effects of an increase in government spending for physical infrastructure, the first scenario here, the higher line, is one where more investment in infrastructure by the federal government is financed by a reduction in other spending. So there's no direct change in the budget deficit. You just have the benefits for the economy of the extra federal infrastructure. In the second scenario, the lower line is one where the extra infrastructure spending is financed by borrowing. In that case, the positive effects of the extra infrastructure is offset to some extent by the drag from the greater government borrowing and the crowding out of some private investment. And the relative magnitudes depend on the specific parameterization. So our goals in the paper are to understand the potential for changes in policies to spur faster economic growth and restrain federal debt, and in particular to show what research evidence is needed to better assess that potential. Because in fact, what we find, and I'll talk about this as I go on, that there is a lot of missing evidence to quantify the effects of policies on economic growth. So the paper reviews evidence from 7 areas of economic policy. The immigration of for each of these areas, trying to understand whether changes in policies will have a significant positive effect on growth, and through that help to alleviate our unsustainable budget outlook. So the first area is immigration of high-skilled workers, and I'll say a little more about that in a moment. The second is housing regulation. Third is safety net programs. Fourth is the regulation of electricity transmission. Fifth was government support for research and development. And then tax policy regarding business investment, and then the permitting of infrastructure construction. I won't have time to go through all 7 areas here. I picked out 3 that I will talk about. As it turns out, our terrific discussant had already separately planned to talk about 2 others. So you will get some sense of the range here. So let me begin with increasing immigration of high-skilled workers, and that's our focus. H-1B visas are currently, I should say, by currently here, I mean where things stood when we wrote the paper a few months ago. This is an area where policy is in flux. But we're capped at 65,000 per year plus 20,000 under special conditions. So we asked, what if the U.S. admitted substantially more foreign workers with advanced STEM degrees? How much would that matter? And you may have seen pictures of the sort of the share of Nobel Prizes awarded to people who live in this country, the share of patents awarded to people who live in this country who are immigrants. And those shares tend to be pretty striking. So we're asking the broader question here about a change in policy. How much difference does that make for economic growth? And we found 2 estimates in the literature one could put together. One is an estimate by Jenny Hunt of the share of high-skilled visa holders who receive patents, and one is an estimate by Marta Prado of the effects of patents on productivity. So you can build up these pieces in a way that hopefully gets you from changes in the number of people coming in through these visas through patents to productivity and economic growth. So we have an estimate in the paper. I won't go through the specifics here, but we conclude that admitting substantially more workers on H-1B visas would boost annual total factor productivity growth. Also just brings more people into the country. That's more workers. They pay more in tax. So the combination is good for the federal budget, higher growth and lower budget deficits. But the magnitudes are pretty small relative to the overall challenges. One would have to have a rather dramatic increase in visas for high-skilled workers to move the needle significantly on budget issues. Here's a picture from a related exercise that Heidi Williams and I did last year. This was a different specific change in the immigrants with high skills. The blue line is CBO's conventional estimate of these policies. For reasons I won't go into here, CBO's estimates focus on the extra spending, the small amount of extra spending for immigrants who receive certain benefits. Those estimates do not include the effects of higher revenue from people paying more in tax. That's what we include in the lower line, together with colleagues at the Penn Morton budget model. And in fact, you can find a noticeable reduction in deficits. But again, for overall magnitude, you'd have to do a lot to make a big difference. Another area we talk about in the paper that's received a lot of attention in economics over the last decade is the effects of investing in safety net programs. And there's a growing body of literature that at least some government programs that provide benefits to lower income families increase the subsequent earnings of children in those families. This kind of analysis requires following people, linking data together over long periods of time. Not every study reaches exactly this conclusion. The magnitudes differ, but the broad conclusion is that a number of these programs are economic investments in a very specific sense of productivity, growth, tax revenue, as well as being humanitarian assistance. And the question is, might the additional tax revenue be large enough even that the investments could pay for themselves in budgetary terms? Budgeteers like me tend to be very suspicious of assertions that certain changes in policies will pay for themselves, but it's not impossible. So there's a, I think, justifiably well-known paper by Nathan Hendren and Ben Sprung-Kaiser from 5 years ago, where they studied the evidence about a large range of programs. This picture is from their paper. The vertical axis is a particular measure of the investment value of different programs. The horizontal axis is the age of beneficiaries. I won't go into specifics here, but the basic theme you should see is that programs that aim their benefits at families with young children, so with beneficiaries between the ages of 0 and 20, tend to have very high payoffs in future economic results. Programs that help older people tend to have smaller payoffs in terms of future economic results. Of course, we provide these benefits for humanitarian reasons as well as investments, but our attention in this paper is on the investment potential. So this paper suggests that maybe there are, in fact, programs that would pay for themselves in a very direct budgetary sense, but we don't really know. That analysis, as impressive as it is, doesn't address the general equilibrium issues like the effects of different ways of financing government programs and how that would matter for private investment and on interest rates. So we don't really know yet. There's a lot of potential here in economic terms, again, as well as human terms, but we don't know in a practical, concrete way what difference this could make to the budget outlook. And this is an area where I think future research can be important. And the third area that I want to talk about today is just reforming the permitting of infrastructure construction. I'm not the expert in our trio of authors on this topic. This is the topic that Zach Liscow has done a lot of work on. There's something called the National Environmental Policy Act, or NEPA, which addresses a whole set of infrastructure projects, basically federally funded projects, federally subsidized projects, as well as some privately funded projects, for example, projects that would cross some piece of federal land. And NEPA basically covers compliance with a whole set of different policies. So it's been discussed now a fair bit in the last few years about whether easing NEPA restrictions could boost economic growth. And so there's a picture that Zach Liscow showed in a separate paper. This picture shows the time it takes to prepare environmental impact statements to meet the NEPA requirements. The horizontal axis shows time, and the vertical axis is the number of years, and you can see a rather sharp increase in the amount of time it takes just to do an environmental impact statement, now working its way up on average to something looks like 4.5 years. So you understand why it might be that if there are ways to simplify that process and reduce the uncertainty people face and firms face in that process, that might be a positive for economic growth. But again, unfortunately, there is not enough credible empirical evidence yet to actually do quantitative estimates of growth effects. The science seems clear, but to know how valuable this sort of change could be for economic growth, and to know how to trade off the economic growth effects against other consequences of changing the law that we might care about, such as protection for the environment, you really want to understand the magnitudes. And we just don't know enough to do that. For this particular exercise, you'd like to know, for example, the distribution of investments subject to NEPA. How many projects are there of what sorts? How large a share are those projects of overall investments in those areas? That kind of information. You also like to know how responsive investment is to changes in NEPA policies. What are the elasticities of different sorts of investments with respect to NEPA changes? And Heidi Williams and the authors of this paper, including me, are trying to pursue that work now. So the bottom lines here are that there are growth-enhancing measures that could probably make a substantial difference to output, and through that reduce the pure spending cuts and tax increases that are needed. And I will say it's nice as somebody who talks about budget problems a lot to have something positive to say and not just come up here and say, well, you know, which kind of hair shirt do you want to wear today? But the magnitudes matter. And so regulatory changes that have little direct budgetary cost offer greater promise here than tax and spending changes. It's not like we should have to pick one or the other, just saying that you look at this issue, the regulatory changes that don't have these direct costs, it's kind of all upside from a growth perspective. But we also should be examining tax and spending changes, and much more research on the quantitative impact of these sorts of policies is needed. And I think our paper was intended to, and I think has helped a bit in spurring work in that area. I know there are projects that are being developed that are meant to fill in some of the specific gaps so that analysts can do the analysis and present quantitative information to policymakers and the public to inform their decision making. So let me stop there. I will just say that our discussant is somebody whose work we draw on importantly in the paper, and it's great that he's here to offer his perspective on these issues. So thank you all very much.
Thank you very much, Doug. I think in some sense this is a great call for a budgetary solution, but it's also, I think, a great call to think about how to improve just the welfare and well-being of people in the sense that you've got more houses, more health care, and everything else with growth. So I don't mean to undermine the topic of our conference, but this is the best possible way to think about addressing these issues. And I think the detail that we now have in lots of the data sets and the large data methods that we have can get us far behind saying some things like we should just deregulate or we should regulate, and actually think about what the specific, difficult, sometimes microeconomic and particular legal fictions there are that we can improve the efficiency of. Our discussant, Karel Mertens, I've gotten to know through his great published work, much of it about exactly the impact of government and government regulation and government spending on the economy. So Karel, thank you very much for coming.
Thank you very much, and thank you very much to the organizers for inviting me to discuss this paper. Being an employee of the Federal Reserve, I need to point that the views expressed here are not necessarily those of the Federal Reserve System or the Federal Reserve Bank of Dallas. So I'm going to start off with a picture that I'm sure you've all seen. Doug showed it as well. This is the latest CBO long-term projection for the U.S. debt to GDP ratio. And as we all know, it is on an unsustainable trajectory. If you look at the similar long-term budget outlook 25 years ago, back then it was already known that it was on a similarly unsustainable trajectory. And we all know that this is, what is behind this trajectory. It's kind of interesting, back then, the government was actually running surpluses, and the 2020, or sort of the 2000 report had different scenarios of what the government was going to do with these surpluses, not save them, save some of it, retire the debt, or maybe accumulate assets. 25 years later, we of course know what happened. Those surpluses were not saved. And as a result of the fiscal responses to two big shocks, the financial crisis and the pandemic, we've kind of reached 100% of GDP about 10 years earlier than what was being projected in 2000. Okay, this summer I attended the Martin Feldstein lecture by Greg Mankiw addressing the fiscal future, where he basically laid out very clearly if something is not sustainable, cannot be sustained, some things will have to change. And so one of the following 5 things will need to happen, and we discussed this last night as well. You can either have some form of government default, you can inflate, you do substantial spending cuts, or some large tax hikes. And the U.S., in terms of the potential for hiking taxes, I think there's quite some, and in that sense, I think the U.S. is quite a bit different from many other advanced economies. But of course, a 5th potential option is just to have some extraordinary economic growth. And so that looks a lot better than those 4 less pleasant options. This is what the paper is about. What is that policy can do to generate some extraordinary growth? Now, the CBO in their latest report actually quantifies how much additional growth would be required to achieve a stable debt to GDP over the next couple of decades. And what I plotted here is just a 5-year moving average of private sector TFP growth, according to the measure of John Fernald. And then the blue horizontal line here is the current expected TFP growth for the next couple of decades that is built into the CBO baseline. It's around 1% TFP growth. And then the red line is the growth rate of private sector TFP that would be required to stabilize the debt. It's 1.6. If you look historically, 1.6 is not unprecedented. Very briefly in the mid-1990s, early 2000s, during the ICT boom, TFP growth was actually stronger than that, but it wasn't very persistent. To really get through TFP growth alone to a stable debt to GDP, you would have to sort of recreate the high TFP growth in the first couple of decades after the Second World War, where it was around 2% or even higher. So ambitious, but not necessarily completely, I think, outside of the realm of possibility. Just to give you a little bit of perspective, I think there's some people that say, well, maybe we don't have to worry too much about the debt to GDP because we're going to get a lot of TFP growth essentially for free because of the AI boom. So what I'm showing here are some estimates. Of course, nobody knows how much TFP will increase because of AI, but there's a couple of estimates out there, and they kind of range from the low end of just a couple of basis points, according to the study by Asimoglu and co-authors. But there are also assessments of TFP growth that are much, much higher than that, several percentage points higher TFP growth. So maybe we don't need policies. Maybe AI will get rid of the debt by itself, but there's just a tremendous amount of uncertainty about that. So the paper lays out 7 different areas, policy areas, for which we have kind of good reasons to believe that they could be enhancing TFP or economic growth more broadly. I think the bottom line of the paper is really that we kind of lack, we have good theoretical arguments. In many cases, we have some good microeconomic evidence for some of the mechanisms that could be growth enhancing. But what we really need is kind of sort of the macroeconomic general equilibrium framework. That's sort of what the CBO uses to do these projections to get a better quantitative assessment of what the growth effects of some of these policies might be. So I basically have 3 comments on the paper. My first one is going to be very similar to, I think, a point that was made at the dinner speech last night. And then I'm going to focus on 2 of them and talk a little bit more about the proposals around the electricity markets and specific issues in electricity right now. And I will talk about government support for R&D. So my first comment is if you look at the model that the CBO uses to calculate the budgetary feedback, i.e., if you get GDP higher by $1 how many dollars in extra revenues do you take in. If you're interested, I put a citation out there. It's quite a detailed model where the CBO looks at all the different sources of revenue, the tax bases, and then assesses what the marginal tax rate is for every revenue source and then aggregates that up. So based on that revenue feedback model, that's how you eventually get to the required additional TFP growth. Unfortunately, I think what the model misses is that policy will over time adjust as well and respond to surplus revenues. So what I'm plotting here is kind of a different way to calculate the budgetary feedback based on the historical experience over the last couple of decades. And there's some dynamics to it. If you see, so what I'm showing here is if you get a $1 GDP windfall, how many dollars do you get in extra receipts? In the short run, you basically get an average marginal tax rate, which exceeds sort of the average economy-wide tax rate of around 17–18%. Then over time, as you average over longer windows, you revert back to the average 18%. And what happens over time is just that the tax code changes, marginal tax rates are reduced by policy changes, and you get far less. And I don't think that's an effect that is in these models. And as a result, an initial significant increase in the surplus, after 10 years, it essentially has vanished and the money has been spent. So yes, economic growth can help a lot, but it cannot if it doesn't go hand in hand with fiscal discipline to sustain surpluses for a little while. Okay, my second point, I want to elaborate a little bit on a section in the paper that talks about proposals to address efficiencies and productivity and electricity. And I think that's a particularly important and somewhat urgent issue, because if we are going to realize these potential TFP effects from AI, we're going to have to address the issues in electricity as well. So for a little bit of context, the sort of electricity output in the US over the last 2 decades has kind of been flat. So demand has gone up, but at the same time, we've gone a lot, electricity use has become a lot more efficient. Now that has changed recently with sort of electrification, electric vehicles, but in particular because of the rapid build out of the data centers, the demand for electricity is rapidly rising. And you can see that in electricity prices. Now a lot of the capacity and electricity generating capacity that has been added over the last few years to meet that rising demand has come from renewables, and that's kind of what is shown in the right graph. And that has created an issues of spatial mismatch between demand and supply of electricity. But there are other issues as well. The sector is facing enormous problems with equipment supply constraints. There's a shortage of transformers, circuit breakers, and turbines, even for traditional gas-based electricity plants. And on top of that, there's important regulatory constraints, and in particular, there are enormously long interconnection delays. On average, across the country, they are rising, and they're up to 7, in some cases even 10 years. And that's not, there's a lot of heterogeneity across the country. In Texas, they are much shorter, for example, and that is one of the big reasons why a lot of these data centers are looking to locate in Texas. Okay, so the paper talks about the importance of building out long-distance transmission in order to integrate markets and match supply and demand geographically more efficiently. And I agree that is an important issue to address for policy. But at the same time, it's not clear that that is the cheapest way of addressing some of these issues. In particular, and I'm by no means the expert, but I have a lot of colleagues that know a lot about this, that tell me that really it makes a lot more sense to focus on energy storage and in particular batteries to address kind of the ups and downs in demand locally. It's just a lot cheaper. There's also a role for policy to force these data centers really to adjust their demand when residential demand it varies over time. And so one policy could just be to force the data centers to have these demand response programs and sort of take up the slack and smooth the loads out. There's a lot of things that policy can do to address what is really a critical shortage of transformers to build out a transmission capacity. And this is also an area where I think more standardization of technologies, which are highly variable geographically across the country, I think could have some substantial productivity gains. Doug talked a little bit about the productivity effects of public infrastructure. The CBO assesses that these are positive return things with some productivity spillovers for the private sector, but they aren't all that big. I think in the literature there's some consensus that that's not necessarily the true for every type of public infrastructure investment. And if you look back, for instance, the Highway Act in the 1950s, I think a lot of economists view that as an example of public infrastructure that really had really meaningful productivity effects. And so I don't know, but if you go the public infrastructure route and you ask me, then I would maybe think of grid modernization and electrification as being one area where public infrastructure could maybe realize meaningful productivity effects. Okay, my final comment is government support for R&D. So government support for R&D in the form of subsidies to engage in research and development, I think has been a very sort of important pillar of what has been the sort of the model of innovation that came out of the Second World War, following the leadership of people like Vannevar Bush and so on and so forth, which is that there's basic research that mainly takes place at research universities with generous support from a variety of government agencies with pretty substantial science budgets to provide that support. I think this kind of model is currently, under question, and not everybody is convinced that this is indeed the best way forward to generate innovation in the economy. Going back to the AI example, I asked AI, so what are the main innovations in AI? Who were the contributors? Where did the innovations take place? And if you ask me, that kind of linear model, which is, admittedly a little bit simplistic, I think there are clear footprints of that linear model, even if you focus on the development of AI. So I do think it is, to a first approximation, still a good model. The issue is that the science budget at these agencies have sort of shrunk a lot over time. So what I'm plotting here is just the budgets, the spending for R&D of the biggest agencies, Department of Defense, Energy, NIH, et cetera, and that spending kind of reached a peak in the mid-60s, about 2% of GDP, but has declined steadily ever since. To the point at this stage, it's like much less than 1% of GDP, and it's mainly defense and NIH spending all the dollars. I do think there is solid evidence, though, that the returns on this type of spending are quite substantial. What I'm showing here is just a simple correlation between the 10-year growth rate and a capitalized version of that spending, R&D capital, and then the 10-year log change in TFP. And there's quite a clear positive statistical correlation. Now, there's lots of issues of reverse causality and so on and so forth. But, in a paper, we try to address those carefully. And we arrive at a calculation that every dollar that the federal government spends on non-defense R&D has a rate of, generates large rates of return of 140 to 210%. And I'm probably getting short on time, but those returns far exceed the returns, similar estimates of the returns in R&D of the private sector. So I'll conclude, and this is my last slide, with I think the issue of government R&D is one area of research where I think we have made some progress in quantifying things and integrating those in sort of a model of economic growth that is useful for the CBO. And in a recent response to a request for information, the CBO has kind of taken on board some of that evidence and stated that every dollar of federal non-defense R&D increases the present value of GDP by $7 to $12. Now, if you apply the 18% tax rate on that, that means that it is self-financing. So the bottom line is, according to the most recent modeling of the CBO, they deem this to be one source of spending that could be indeed self-financing. Now, whether you can scale it up to stabilize it, that is, of course, much more doubtful. Thank you.
So actually, I'm going to turn the mic over to Doug just to take a couple of questions on this session, and Karel, you can step up if questions come for you. So please, let's just have Peter probably start things off here. Go ahead, Peter.
Peter. Turnabout's fair play, Peter. What's your question?
Really, for Doug, but especially where you ended, Karel, I want to interpret one of your early slides, ask you the meaning of it, because it seems you both coalesced on a dramatic point. The slide that showed the bigger impact for a dollar converted to investment, for an existing dollar in the budget than a borrowed dollar. We all understand why that's so. But I think the effect is dramatic because if you reach in to federal spending, odds are you'll find a dollar supporting consumption. And so you're reaching into the grab bag of federal spending and magically saying, no, we're putting it in investment, which is exactly where you ended. And so the most dramatic effect you showed, both of you, is no, spend an additional dollar and if we know it's an investment, really, then we get a really big bang. And I just wonder if that's the most compelling conclusion you both came to. So that's sort of an interpretive question.
Yeah. So I think it's a starting point, Peter. You're right that if you take a dollar that would have been used for consumption and put it into investment, and you get some payoff in the future, that shouldn't be a shock. That's what we mean by consumption versus investment. I think that's right. In the analysis that CBO does, they don't even quite say the grab bag. They just presume it is something. They state it is something that will not affect future output. But still, even among investments, there is the question about how valuable certain investments are. So in physical infrastructure, for example, there are crucial pieces of infrastructure, and there are bridges to nowhere. And so it matters how those investment dollars are allocated, right? It's not just a matter of total amount, it's how they're distributed. But also there are different kinds of investments. And it turns out that R&D, and Karel is a key author here, R&D seems to have quite a large payoff. In CBO's analysis from a couple months ago that Karel referred to, that he and I were talking about, and I actually asked some questions of a former colleague at CBO a couple of days ago. In that report on R&D, CBO seems to find that not only consumption dollar moved into R&D investment would pay for itself, but that in fact, even if you borrow the money and put it into R&D, it might pay for itself because the payoff to the public R&D seems to be especially high. And so high enough that it exceeds the crowding out consequences. And so that's particularly interesting. And CBO has this nice letter and has said to us that they will be producing a longer report with more explanation in the coming months. And we look forward to seeing that. But that's why the quantitative estimates are so crucial, because it's not just knowing the sign and understanding the logic. It is actually knowing the numbers that Karel and his co-author have produced.
Can I jump in? Hi, Rich Claret. Enjoyed this and will study it. Just 3 questions about this, more about the literature than the approach. First is multi-factor productivity has the benefit that you're taking a stand on where the productivity comes from. It's just not a residual. But that it also makes it more challenging, I think, to allocate in different scenarios. So sort of a comment on multi-factor versus just output per worker. Secondly, do the models factor in that if you get more rapid growth, you may get higher interest rates? And then thirdly, do they worry about diminishing returns? That is, you may find a local effect that X going into R&D delivers this nice pop, but if you went all the way there, at some point, don't diminishing returns kick in? I guess in certain growth models they don't, but that would be something I'd think about if we tried to sort of push this. But really, these are probably more about the literature than the paper. Thank you.
Thank you, Rich, for those questions. On the first one, we focus in our paper on total factor productivity, but the real issue is economic growth. What the models that CBO and other people use incorporate is that if there is faster productivity growth, that will tend to raise wages and thus induce more labor supply. It will tend to encourage more capital accumulation. And CBO and other modelers' reading of the literature in those areas will be built into the models and will be part of the results that you'll find. CBO also in particular models the effect of faster growth on interest rates. And traditionally the models they've used have had nearly one-for-one effects, so that a 1 percentage point faster economic growth rate raises interest rates by 1 percentage point. Now they're always adjusting the models, and I don't know exactly what the current moment is, but that's what's been true in the past, and that is incorporated. And that matters a lot, and it matters increasingly with debt growing, because an extra percentage point in the interest rate with debt at 100% of GDP makes a whole lot of difference in the debt path relative to what it would have been 10 or 20 years ago. On your third point, oh yes, so diminishing returns. So I don't think we know a lot about that. I think the estimates are basically on the margin, and when CBO does an analysis of this, they will pick some number that is not quite $1. They pick something that you can get that looks noticeable, but is not seeing how far you could go. So it's not doing the 2x, the 3x, the 5x, and so on. And I think that's something else that we would like to understand better. But at the moment, there are a set of policies we don't even understand what the effects on the margin would be in a quantitative sense, and I think that's the current focus of research.
Thank you very much. Let's just have a round of applause partway through for Doug and Karel. The next paper is on expanding the scope of deposit insurance, which came up at the end of the last talk. The author and presenter is Shohini Kundu, who has come all the way from the West Coast. She's an impressive researcher already. I got to know her by Zoom many years ago when she was awarded the BlackRock Applied Research Award, and we're very happy to have her here today to tell us about expanding the scope and cost of deposit insurance. Thank you, Shohini.
Just setting a timer. Okay, first I'd like to start by thanking Debbie for inviting me. It's a great pleasure to be here. So today I'll be talking about the expanding cost and scope of deposit insurance. Deposit insurance prevents bank runs. It's been a cornerstone of financial stability since 1933. But it also creates a massive government liability. As of 2023, there are over $10 trillion in insured deposits in the US banking system. And the FDIC Deposit Insurance Fund, the actual reserves that back this guarantee, stands at just $128 billion. That's a coverage ratio of 78-1. So for every $1 in the fund, the FDIC guarantees $78 of deposits. And this is a contingent government liability. It's large, it's difficult to measure, and what I'll show you today is that it's also mispriced. Banks don't pay premiums that reflect the true market value of the insurance that they receive. And so today I'll present two papers that examine how this government guarantee affects the banking system and what its implications are, what its fiscal implications are. So the first paper is titled "The Economics of Network-Based Deposit Insurance." For context, a common feature of deposit insurance programs worldwide is that regulators set nationwide limits, providing depositors with the exact same insurance benefits irrespective of their banking relationships. This uniformity leaves little room for banks to enhance their clients' deposit insurance coverage. A new financial innovation known as reciprocal deposits has disrupted this system by allowing banks to effectively offer unlimited deposit insurance coverage. So in this paper, we first document that reciprocal deposits have expanded government exposure by almost $500 billion. And second, we document its effects on depositor behavior, banks' risk-taking incentives, and their market structure. We then turn to addressing how government guarantees affect the deposits supply. We quantify the subsidy from mispriced insurance, and we show that banks actively exploit this subsidy through liability management. So it's not simply that in response to subsidies, banks take on riskier assets on their asset side, but they also optimize their funding structure to extract maximum value from these government guarantees. So let me start with the first paper. Under their traditional deposit insurance program, if you take $1 million to your bank, $250K will be insured, represented in green, and the remaining $750K will be uninsured, which is represented in black. Under the reciprocal deposit insurance program, your bank will break the $1 million into 4 250K chunks and exchange 3 of these chunks with 3 other banks in a fully offsetting manner. So to make it concrete, if I have 500K and you have 500K, our deposits are uninsured. But if we split it into 2 250K chunks in exchange with each other, now we will have obtained full deposit insurance coverage on the entirety of our deposits. And so if you're an NBA fan, you might be aware that Giannis Antetokounmpo, who plays for the Milwaukee Bucks, took his first paycheck and split it across 50 different banks to stay fully insured. The reciprocal deposit market would have avoided this hassle by allowing him to maintain relationships with a single bank and obtaining full deposit insurance coverage on the entirety of his deposits. So what we saw was that in the aftermath of SVB's failure, demand for reciprocal deposits surged. For example, PacWest, which is a large regional bank headquartered in Southern California, offered up to $175 million in deposit insurance coverage per depositor, which is 700 times the FDIC cap. And the way they did this was by enrolling their depositors in their reciprocal deposit networks. And this isn't a case that's isolated to the West Coast. We see that New York community banks similarly utilized reciprocal deposits to increase their share of insured deposits to 95%. And when this was announced, it assuaged investors' concerns regarding the bank's instability, and the share price increased by 5%. So are reciprocal deposits a new phenomenon? Reciprocal deposits have existed since the early 2000s, but they weren't commonly used up until 2018. And this was due to their classification as brokered deposits. Brokered deposits are generally unattractive because they carry higher insurance premiums than standard deposits. This changed after an FDIC ruling in 2018, which exempted reciprocal deposits from being classified as brokered deposits. And what we see is that, consequently, the size of this market more than tripled in a matter of 4 years, from the beginning of 2018 to the end of 2021. The second major shift of this market occurred within weeks of SVB's failure. After SVB failed, the total dollar amount of reciprocal deposits surged by 41% and continued to rise thereafter. While reciprocal deposits are used by banks of all sizes, they're most commonly used by small banks and mid-sized banks with assets below $100 billion. And this pattern of usage is consistent with the idea that the largest banks benefit from a too-big-to-fail guarantee, so they're less inclined to use reciprocal deposits. So overall, our findings highlight 2 key economic drivers of this market. The first is regulation, and the second is concerns of depositor flight. Now, although the total dollar amount of reciprocal deposits surged following SVB's failure, the number of banks on the network only increased by a meager 7%. And this is because there are considerable frictions to joining the reciprocal deposit network. Network participation is pretty sticky. So from 2011 to 2018, the network participation rate was stagnant at around 20%. After the broker deposit ruling, participation increased to 30%. But note, this wasn't a discontinuous jump. It took almost 2 years for banks to fully ramp up their participation. And again, following SVB's failure, what we see today is that more than 40% of banks in the US banking system have some kind of reciprocal deposit arrangement. So where are these banks located? We find that these banks which utilize reciprocal deposits are located nationwide. And this geographic pattern is consistent with the nature of this technology-enabled platform that can connect banks with each other irrespective of where they're located. Who uses reciprocal deposits? Reciprocal deposits are commonly used by high net worth individuals, small businesses, and public entities. Public entities have become increasingly prominent users of reciprocal deposits. That's somewhat surprising because they're 4% of total deposits and yet 30% of reciprocal deposits. And in the paper, we explore this concentration, and I'm happy to talk more about this during Q&A. So we began by doing a simple comparison of banks that were already on the reciprocal deposit network by the first quarter of 2022 to those that were not on the network. And what we see is that going into the crisis, network and non-network banks experienced very similar growth rates in insured deposits. After the crisis occurred, network banks reported significantly higher growth rates in insured deposits relative to non-network banks. Now, by the end of 2023, the growth rates converge, but we see that there's notably almost an 11% cumulative insured deposit growth gap between the network and non-network banks. What's remarkable is actually the pattern for total deposits. After the crisis hit, network banks experienced a relative increase in total deposits, while non-network banks experienced a decline. And again, by the end of 2023, we see the growth rates trend in parallel again, but the network banks have notably almost a 5.5% advantage in cumulative total deposit growth relative to non-network banks. So in this paper, we essentially have three key findings. On the depositor side, we find that access to enhanced deposit insurance deters bank runs during times of financial instability. And our ability to leverage cross-sectional variation allows us to estimate the semi-elasticity of the supply curve for insured deposits, which is a novel contribution to the literature. Now, on the bank side, we find that banks with higher deposit insurance coverage increase their risk-taking. We find evidence that they invest more in assets that have both more credit risk as well as more interest rate risk. And lastly, we study the implications of this reallocation on the industrial organization of the banking sector, which has yet been unexplored. And we find that access to enhanced deposit insurance increases the local market share of banks, particularly smaller banks, eroding the too-big-to-fail advantage that the largest banks enjoy. So in some sense, deposit insurance can substitute for bank size as a form of depositor safety. Now, these findings raise several important policy implications, but let me just highlight two of them. A key statistic in the banking literature, as well as for regulators, is to understand the sensitivity of a bank's failure probability to an increase in the deposit insurance limit. Now, due to the explicit and sometimes implicit government guarantees, we haven't actually observed that many bank failures in practice, so it's difficult to precisely compute this measure. But we do make some progress on this front by conducting a case study of 5 banks that were in distress during the 2023 banking turmoil. So SVB, First Republic, and Signature Bank are 3 banks that had minimal usage of reciprocal deposits. And these banks ultimately failed. By contrast, PacWest and Western Alliance are 2 banks that were arguably equally troubled, but had increased their usage of reciprocal deposits even before the crisis had started. Once the crisis began, these banks accelerated their usage of reciprocal deposits, which was mirrored by a reduction in their uninsured deposit percentage. And these 2 banks ultimately survived the crisis. So the concern from the FDIC's perspective is essentially a concern of mission creep. One of the founding objectives of the FDIC has been to protect small depositors. Large depositors can protect themselves. Initially, it was conceived to protect up to $2,500 of deposits per depositor per account, which is $58,000 today. The increasing use of reciprocal deposits effectively extends deposit insurance to even large depositors, altering the scope of protection within the system. So now, depositors can effectively obtain unlimited coverage through reciprocal arrangements. That's added almost $500 billion in government exposure to the FDIC. And so whether this extension is desirable or not from a social welfare perspective requires additional analysis. But our findings do raise 3 immediate policy considerations. The first is whether the FDIC should revisit its deposit insurance pricing scheme, given that now they're effectively insuring a larger pool of liabilities. Second is that given that people can now achieve higher deposit insurance coverage limits, is it time for the FDIC to reconsider its deposit insurance coverage limit and raise it perhaps for all depositors? And in doing so, how do they design a system that restores market discipline while also maintaining financial stability? So let me summarize what this first paper shows. It documents a massive expansion in reciprocal deposits from $25 billion to almost $500 billion. It shows us that during the crisis, banks that had access to reciprocal deposits were not only able to retain existing deposits, but also attract new deposits. And with this new inflow of deposits, these banks invested in riskier assets, and they experienced an increase in local market share. But the fundamental question remains, which is how large is the government subsidy that drives bank behavior? And are banks actively managing their liabilities to extract maximum value from government guarantees? The second paper precisely answers this question by quantifying the subsidy and showing that banks optimize their liabilities in response. So let me turn to the second paper. Deposit insurance prevents bank runs, but it also creates a massive hidden transfer from the government to banks. The issue is that regulators can't price deposit insurance to match the true fundamental bank risk. So premiums typically range from around 0 to 60 basis points, but fundamental bank risk can vary far more than this narrow band suggests. And so what we already know from decades of research is that subsidies encourage banks to take on riskier investments on the asset side of their balance sheet. But what we don't know is whether banks also optimize their funding structure. The question is, are banks also restructuring their liabilities to extract maximum value from the government guarantee? And so the implication is that if the subsidy varies with bank risk, it can change the marginal cost of deposit financing. And so when banks become riskier, deposit insurance becomes more valuable. And so the cost of using insured deposits becomes relatively cheaper. And that can independently explain shifts in the supply curve of insured deposits. So this figure illustrates the FDIC's assessment rate over time against the federal funds rate. And you can see that there's very little time series variation in the assessment rate that's paid to the FDIC. Despite regulators' attempt to have larger banks and riskier banks pay higher premiums, there's still a substantial gap between the economic risk and premium payments that are actually received. So to understand the economic implications, we can think of deposit insurance as essentially a put option that's held by the banks. If the value of the assets falls below the value of deposits, the FDIC steps in and covers the difference, effectively allowing the banks to put the assets to the regulator at the face value of deposits. Now, the value of this put option is not static. It varies with bank risk in the cross-section, and it also varies over time. So when banks become riskier, the put option becomes more valuable. And when banks become safer, the put option is less valuable. The result is that riskier banks enjoy a larger subsidy because they effectively pay a flat premium for an increasingly valuable government guarantee. And so this effectively reduces the cost of insured deposit funding for risky banks. So the research question we ask in this paper is, how does the deposit insurance subsidy affect banks' funding choices? The mechanism we present is that when banks become riskier and their subsidy is higher, they raise insured deposits to extract maximum value from the government guarantees. Now, our empirical strategy is to measure the subsidy through variation in bank risk over time, as well as use an instrumental variable approach to isolate the liability channel from the asset channel. We need to be careful here because there's a reverse causality argument that might be at play, which is that banks that have more deposits may simply invest in riskier assets. And what we find is that banks don't just use the subsidies to take on more risk on the asset side, which is the classic moral hazard argument, but they also actively restructure their liabilities to maximize the government transfer. And that is what we call the deposit put channel. So we can sketch a model of the market value of deposit insurance where the bank's optimization problem is to maximize the value of a put option net of convex costs of raising deposits as well as the premium that's paid. And what we get is the optimal quantity of deposits is given by D star up here, but the key comparative static is understanding how the optimal quantity of deposits varies with bank risk. The model predicts that when bank risk increases, the quantity of deposits also increases. So next, we turn to data to understand whether these relationships actually hold up empirically. In this figure, we present the year-over-year change in total deposits against the year-over-year change in non-performing loans. So non-performing loans is used as a proxy for bank risk and also the value of the subsidy. What we find is a strong correlation between total deposits and NPLs of almost 30%. Now, when we turn to insured deposits, this relationship is even stronger. And this is consistent with the idea that insured deposits stand to benefit the most from government guarantees, so the correlation ought to be stronger. And we find a correlation here of almost 60%. Now, the advantage of using NPLs is that it's available for all samples, all banks in our sample, from the start of the call reports, which is 1976. But you might argue that perhaps market-based measures might be a better proxy for bank risk. So we demonstrate robustness with a number of market-based measures, such as bond credit spreads, CDS spreads, and the implied volatility. So I'll show you for implied volatility, we find very similar correlations of almost 30% with total deposits and close to 60% when looking at insured deposits. So the pattern is fairly robust. Now, there are three key results in this paper. The first is what I already showed you, which is that risk and insured deposits move together. Second, we turn to the cross-section and we show that riskier banks raise more insured deposits. And here we conduct the analysis at the branch level, which allows us to observe both quantities and prices jointly, as well as account for local economic factors that might drive the relationships between insured deposits and bank risk. And that allows us to distinguish supply-side explanations from demand-side explanations. Now, third, and most importantly, is that we find that total deposits increases, which you may have guessed from looking at the figures. So when a bank becomes riskier, uninsured depositors flee, which is the market disciplining effect, but insured deposit growth more than compensates the loss from uninsured depositors. So what's surprising is that risky banks end up with more funding and not less. Essentially, the subsidy overwhelms the disciplining forces of uninsured depositors. So to understand whether this is quantitatively relevant or not, we can do a back-of-the-envelope calculation. So let's suppose we have a bank that has $100 of assets backed by $80 of deposits and $20 of equity, and it has a 1% ROA. Now, suppose that the market value of insurance is 50 basis points. So this is what a private insurer would charge. If the regulatory assessment is 20 basis points, then the subsidy is 30 basis points. On $80 of deposits, that's a 24-cent subsidy. Now, is this substantial? Well, to put it into perspective, on $100 of assets, that's almost a quarter of the baseline ROA. And on $20 of equity, that's 1.2% of ROE. Now, this is for a relatively safe bank, but the estimate is substantially larger for riskier banks and for banks that have lower equity capitalization ratios, which benefit more from government guarantees. So putting this all into perspective, if mispricing is of the order of 30 basis points and we have $10 trillion of insured deposits, then this deposit put channel estimates that at the least there are $30 billion per year in a hidden annual fiscal transfer from the government to banks. Now, the first paper showed us that reciprocal deposits have had $500 billion in government exposure, and again, at 30 basis point subsidy, through this deposit put channel, there's an additional $1.2 billion a year from financial innovation alone. What's particularly concerning, though, is that the subsidy increases with bank risk, and banks respond by expanding deposits. This creates procyclical government liability because it's precisely largest when the financial system is already under stress, when crises occur, and when the fiscal burden is high. So let me conclude. Together, these two papers reveal the hidden costs of deposit insurance. We show that mispricing creates a very large annual subsidy from governments to banks each year. Financial innovation has increased the size of government exposure through the new guarantees. The total contingent liability is large, it's difficult to measure, and it's rapidly growing. And a fundamental trade-off is how we balance financial stability against the costs of moral hazard, as well as fiscal costs that the government may have to face. Thank you.
Thank you very much. Our discussant is Deniz Anginer. Thank you.
All right. Well, thank you very much for the invitation and giving me an opportunity to discuss this paper, rather two papers. Shohini will get 2 sets of comments for the price of 1. Thank you. Okay, so let's start with the first paper, which is the economics of network-based deposit insurance. So Shohini and her co-authors studied these rather interesting reciprocal deposit networks. So they used the 2018 FDIC exemption as a quasi-exogenous shock to adoption and examine the impact on network banks during the 2023 Silicon Valley Bank crisis. So they have 3 key findings. The first one is that network accessed stabilized funding for these banks. Network banks also had lower CD rates and were able to attract a lot of deposit inflows, which is consistent with the demand shift. At the same time, this led to an increase in moral hazard, led to greater risk-taking by these banks. They increased their security holdings, increased the maturity gap in their portfolios, and gave out riskier CRE loans, which showed up in terms of higher defaults and delinquencies. So I thought this was a very interesting paper, so I'll provide some comments on big picture issues, moral hazard, and also provide some specific comments on the estimation, some of the technical details to help improve the estimation and identification in the paper. To start with, I don't know if the data is available, but it would be great to see more detailed information on these reciprocal deposits, the average number of deposits, the size, how they're split up, how they're dispersed across banks, and also a bit more information on the customers other than the public entities, especially those that entered as new customers starting in first quarter of 2023 after the Silicon Valley Bank went under. So a couple of comments on the impact of these networks on flows. There are a couple of interesting results, and I thought it would be useful to provide a little bit more color to some of the results that we see in the paper. First, customers converting from uninsured to insured is fairly low. You would think that existing clients who already have a banking relationship would be sort of like the natural buyers of these products. So it's interesting that we're not seeing that and why that is the case. You also see an increase in deposit flow for these network banks, excluding reciprocal deposits. So there are a couple of different stories here that would be consistent with results. Is it because they are now deemed less risky by market participants because they have access to guaranteed funding right now? The impact on risk-taking, I thought the results here were not as convincing. First, the maturity gap and duration of securities can rise mechanically. So you're getting all these inflow of deposits. If you just park them in longer fixed income securities at a time when their yields are much higher now, their prices have come down, you're going to see this increase in the maturity gap. And this is just opportunistic carry rather than sort of deliberate hunting for risk. So it's good to separate that carry from moral hazard. When looking at delinquencies and defaults, this is going to be tough to do. The time frame is just too short, right? Everything happened very quickly, beginning of Q3 2023. You have the crisis. If you look at the regional bank indices, there's almost 80% recovery by the beginning of the Q1 2024. So during this time, these banks, because they get access, they're going to take on a lot of risk, give out really risky loans, and we're going to see all of that delinquencies, defaults within that very short time frame. The impact on pricing. So it would be good to maybe talk a little bit about this effect of the rate bridge. So within the network, if you charge a higher rate, you're supposed to subsidize other banks, your counterparties, in order to harmonize the depositor experience. So what is the impact of the rate bridge on the CD rates that they charge? So these internal transfers that banks have within the network, how does that affect the price elasticity that we see in the market. Also, the results in the two papers give not necessarily conflicting results, but two completely different results when it comes to pricing. In the first paper, what we find is that increasing access to guaranteed, expanded guarantees leads to a reduction in rates, okay? So in the first paper, it's argued that this is consistent with a demand shift. So the demand curve for deposits is gonna shift to the right, it's gonna increase quantities and lower rates. That's fine. In the second paper, we find the opposite results. Again, the mechanism is the same. We essentially have expanded access to government guarantees in both cases. But in the second paper, you have an increase in rates. And the argument in the second paper is that, well, you're going to have a shift in the supply curve. So the supply curve for deposits is going to shift to the right, quantities are going to go up, and rates are also going up. But really, the logic in the paper, in the second paper, I thought really applies to the first one. So in the second paper, banks are expanding supply of deposits. Why? Well, it's mispriced. It's cheaper for them now. They're going to go expand their balance sheets, increase their assets, give out more riskier loans. But there is no evidence of that in the second paper. All of that is in the first paper. So I think it would be good to sort of think about the mechanism and why you have sort of like differential effects in these two places. So the paper uses the 2018 FDIC exemption as a shock that induced adoption into networks. And endogeneity and selection is sort of an easy thing to criticize, and I don't have a lot of useful comments here, but I thought it would be useful to include a lot more controls. The controls that are used are fairly thin. So things like reliance on deposit funding, ALM maturity mismatch, which was very important during the SVB crisis. It would be also good to look at characteristics between network and non-network banks and do some sort of a matching and use that as a control group. So the issue is that there's going to be a certain set of bank characteristics that's going to both drive entering into the network as well as their risk in the future. So it's going to be a causality issue. Another way to deal with this would be to take these banks who have switched into the network, compare them to non-switchers, and look at shocks before 2018. So the idea is that if it is bank characteristics that are driving it, so these banks are less risky or have better access to liquidity for whatever reason, then we should find similar results. If it's truly the network that's driving it, then we won't find anything. Also, when it comes to trends, some of the charts look like they had some trends in them. It would be good to increase the sort of like the window estimation for clarity and look at some bank-specific pre-trends. Okay, when it comes to policy implications, I thought there was a disconnect between some of the results and the discussion. There's great discussion on industrial organization, competition, how having access to network are allowing the smaller banks to compete with larger banks who benefit from implicit guarantees, which is great because the US banking sector has been getting more and more concentrated, and there was a lot of discussions after the failure of SVB whether that's going to continue in war with depositors fleeing to larger banks in order to get that implicit guarantee. And I flew in from Canada. We have only 4 banks that control about 95% of the market. And it has real economic implications. We pay higher for mortgages. We have fees. The technological innovation is not there. I'm still asked to fax forms to my bank. So that part is great. But a lot of the discussion was sort of in a positive light. There's also discussion how these network providers actively monitor each other and they kick some of them out if they believe that they're too risky. So in a way, providing market discipline. But this really sort of misses the mark, really. The real trade-off here is with moral hazard. So even within this very short time frame, the results in the paper show that once they get access to expanded guarantees, they are just expanding their balance sheet, giving out a lot of risky loans, taking on a ton of risk. That's the real trade-off. I think more discussion of that would be useful. Okay, second paper, how the government guarantees affect deposit supply. So Shohini and her co-authors use the fact that deposit insurance premium is coarse, slow-moving, which will cause mispricing. So banks will take on a lot of risk. Deposit insurance is not risk-sensitive. It's essentially going to provide a time-varying subsidy to these banks. And when that subsidy is high, they're going to increase their deposits, give out riskier loans to take advantage of that put option whose value has increased. So they proxy risk using non-performing loans and use this interesting instrumental variable, looking at the weights on asset classes 3 years ago, and then looking at NPL values today. So the idea is that you're going to get a big shock to non-performing loans for these different asset classes today, but we're using weights from 3 years ago. So it's going to reflect, if the risk increase is going to reflect the decisions that these banks have made 3 years ago. And what they find is that these NPLs raise total deposit by about 16% for each standard deviation increase in the risk. So this is consistent with a supply shift. So in terms of identification, it would be good to see how sticky these portfolio weights are. And what they do in the paper is they use average non-performing loans for each of the asset classes as shocks. But these aren't really shocks. So these portfolio sets could be based on expecting default rates going forward. So if you wanted to take on more risk in order to exploit the implicit subsidy provided by deposit insurance, you're going to invest in asset classes that have higher default rates, right? So what might be more useful is looking at unexpected deviations, even just simple deviations from average default rates might be a bit more useful. Also, we're assuming that these NPL shocks only affect the deposit through banks' induced risk, not via deposit demand. So that we can isolate the supply side of things and separate it from demand. But even though supply and the demand affect price differentially, as I mentioned before, they're going to affect the quantities in the same way, which raises issues of whether this IV violates exclusion. Also, I had trouble making this macro-micro link in the paper. So all the identification, all the analysis is cross-sectional. So the idea is that there's going to be a big, massive shock. This is going to affect banks differentially based on decisions they made 3 years ago. Some are going to become more risky, and they're going to exploit the subsidy coming from the deposit insurance by expanding their deposits. How many banks are going to be affected? We don't know. But for these results that we see at the macro level, at the aggregate level, it has to impact a large number of banks. The problem is, if it affected all the banks, you would not be able to find anything in the cross-section, right? All the banks are affected the same way. When you run the regressions, you're not going to find anything. So you're sort of caught between a hard and a rock place in the sense that in order to get these strong macro-type results, it will imply that in the cross-section, the identification is going to be weak. Speed up, okay. One final comment. So another thing, they have this interesting model in the paper where leverage is constant. So the deposit growth comes from loan generation. So there's a one-to-one match between deposits and loans. So if we were to take loan growth as opposed to deposit growth, we should find the same results. Run the regressions again, we should find exactly the same results. But I don't think that will be the case. If you look at loan growth, it's unlikely that these banks who have taken on who are suffering from an aggregate shock, who become risky, are going to be increasing their balance sheets. So if you think about the pricing of deposit insurance in the Mertens model, there are two key components. There's leverage, and there's asset volatility. But the two are related, and most likely they're going to be related in a negative way. So to the extent that there's market discipline in the market, as asset volatility goes up, there's going to be pressure on banks to reduce their leverage. And this is something a number of papers have used to actually quantify risk shifting. So if you look at the impact of asset volatility on deposit insurance premiums, there's going to be two components. There's going to be the first component that captures the incentives of financial institutions to increase risk, and a second component, an offsetting effect, that's going to moderate this risk because of market discipline. So a more consistent story, I think, for the second paper would be really once after banks get these aggregate shock, they become more risky, they're going to increase their deposits in order to repair their balance sheets. They're going to de-lever, repair their balance sheets. So this is, I think, a more intuitive and coherent story. It's not necessarily inconsistent with the results, but something to think about. So, thank you.
Very quickly, excellent presentation, excellent paper. Look forward to reading it in full. You mentioned SVB, First Republic, and Signature as being outside the network, the reciprocal network. Is that right?
So these banks were part of the reciprocal deposit network, but they had almost minimal usage of reciprocal deposits.
Yes, right. And they all failed.
And they failed.
I would point out that SVB had $15 billion in borrowings from the Federal Home Loan Bank of San Francisco when it failed. First Republic had $28 billion from the same home loan bank when it failed. And Signature had, I think it was $11 billion when it failed, right? So my question, or maybe it's a comment for your next paper, is to factor in how the availability of home loan bank borrowings, which are also subsidized to the tune of $30 or $10 billion a year, according to the Congressional Budget Office, how that impacts your analysis. And also, each of you mentioned market discipline. There is no market discipline when it comes to home loan bank borrowings because the home loan banks, the 11 home loan banks, are indiscriminate lenders, right? Whereas some depositors do exercise market discipline. And that's a contrast that you might want to comment on and focus perhaps in another paper.
That's a great point, and I think FHLBs are certainly an understudied area of research, and many of the things that we study here with deposit insurance are relevant. You may be concerned that that the federal home loans might be correlated with reciprocal deposit usage, so we explicitly controlled for, and we don't find any relationship between usage of liquidity from FHLBs and reciprocal deposit usage.
Excuse me. To that point, Signature, but certainly Silicon Valley Bank's a special case. They were punished by the government because they had too many depositors who were in the crypto space. Just having the word crypto or blockchain caused the regulators to shut them down. Then there was a run on the bank by their stakeholders, who were the VCs who had forced the portfolio companies to put their money there. So they're a really special case.
These banks certainly failed some of them failed for different reasons. Some of them had concentrated depositor bases that others didn't, some were concentrated on both the asset side and the liability side. First Republic, in the first quarter of 2023, they had tried to staunch the bleeding by taking $3.5 billion in reciprocal deposits and an additional $2.5 billion in brokered deposits. And many argue that they would have failed faster and fallen harder had they not had access to these markets. So the point is that the reciprocal deposits and these other forms of deposit funding can help these banks at least survive or give them liquidity lifelines to make it to tomorrow. So that's a tricky question. The overall liability to the FDIC has increased. So a simple solution would just be to price reciprocal deposits, charge higher premiums for them, and not treat them like standard deposits. That would be a simple way of doing it. The FDIC has been trying to move closer to risk-based pricing, but of course it's a challenge because oftentimes the measures of risk are based on course categories, often a 3x3 matrix or a 4x4 matrix, and not necessarily based on a continuous, a continuum of risk.
One last question. Yeah, quick question. Given this, you know, the environment in terms of what is guaranteed and the ways to expand that guarantee infinitely, any thoughts of the government bailing out those depositors? And connected to that, why even bother? Right? And so if the FDIC is basically an unlimited deposit source, why go through even the whole process? Because we did fully guarantee all the depositors in those institutions. I thought at the time I was curious. I find it even more curious hearing your paper.
So I think what's important is that the FDIC's guarantee it's almost like a conditionality of assistance. What happened in 2023 was they ended up effectively insuring all deposits in the system, but that assistance is supposed to be conditional. So during systemic crises, they often bail out everyone, but for idiosyncratic reasons, they could let banks fail. And even after 2023, there have been a couple bank failures where I think there was a bank in Oklahoma. Usually the names are some permutation of the words Citizens or Republic. I think Republic First or Citizens First, something like that. But they had let the uninsured depositors lose money. So it's not always the case that they're going to, they're 100% going to bail out all deposits. I think one key concern is that interconnectedness has increased. So if a local school district places their money with their local bank that reciprocates with SVB, it could create reputational concerns. And even beyond reputation, if they have the slightest delay in accessing their funds, it could heighten panic and trigger a broader contagion. So I think what our findings suggest is the need for proper disclosure regarding a bank's reciprocal counterparty so that policymakers can formulate better resolution plans in the event of a crisis.